Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Today, we're doing a deep dive into three really distinct but deeply connected movements in the financial world. And they signal that the fundamental rules of the game are, well, they're changing.
That's right. We're not talking about the day-to-day noise. We are looking at tectonic shifts, things that affect structural inflation, global capital flows, and most importantly, your personal savings.
First up, we're going to look at the accelerating, almost relentless price surge in key industrial metals. We're talking copper and silver. This is way beyond simple market speculation. It's screaming about long-term global inflation.
Then we'll zoom out a bit. There's a fascinating new capital highway forming, connecting Saudi Arabia and Japan, and this flow of money is creating an economic bloc that's, well, it's starting to operate outside the traditional Western orbit.
And finally, we'll get into the hidden risks inside one of the most popular new investments for retail folks, fixed maturity funds, or FMFs. These funds are attracting what we're calling bond tourists.
Bond tourists? I like that.
Yeah, investors looking for high returns who might be overlooking some really serious dangers.
Yeah.
So let's start with the loudest siren of them all right now.
The commodities market.
Okay, let's unpack this commodity chaos first, because the price action is, frankly, historic. The data shows both silver, often called the poor man's gold, and copper, Dr. Copper, because its price is such a great indicator of economic health. Both have hit all-time highs globally.
And what's really fascinating here is the momentum. I mean, recent analysis shows these metals are just powering through short-term issues like that mid-November liquidity outage on the CME.
Right. They just shrug it off.
They did. They dipped for a moment and then kept marching higher. It just shows you there's this deep structural buying pressure underneath it all.
And you can see that pressure when you look at the mining companies themselves. The data we reviewed shows giants like Freeport-McMoRan, Jiangxi Copper, their net profits are surging over 50% year over year, which is, of course, fueling massive stock rallies. And this is it's a textbook example of the leverage effect in mining, and it's really important for investors to grasp.
Okay, so explain that. What's the leverage effect?
So mining has these enormous fixed costs, right? Heavy machinery, labor contracts, all that infrastructure. If the price of copper rises by, say, 10%, their profit on every new ton they sell can jump way faster. Maybe 25 or 30%.
Because their costs stay the same while the money coming in just soars.
Exactly. And that brings us to how this connects directly to global inflation. We need to talk about a very specific number coming out of China, 90,000.
Right, the Shanghai Futures Exchange.
That's the one. The copper price there is challenging 90,000 Chinese yuan per ton. In trading, we call that a major handle.
A handle. Break that down for us. What does that mean in this context?
Think of it like a historic ceiling, a huge psychological and technical barrier. Copper has bounced off this level for years. If it breaks past 90,000 and, more importantly, stays there, it signals a fundamental new regime for the market.
A new regime?
Yeah, it means the metal has basically left its old price range behind for good and entered a completely new structural level.
So if China's internal manufacturing costs hit this new ceiling, what does that mean for, say, the American consumer buying a TV?
It means that China's long era of deflation export, that constant flood of cheap goods, is probably ending. Copper is in everything, electronics, appliances, you name it. When China's internal costs are forced up like this, they have no choice but to pass that on. They're about to start exporting inflation.
And the whole situation just seems to be getting tighter. On the supply side, we just saw that news. Major Chinese copper smelters are planning to cut production for 2026.
Right, because of ore shortages and new energy efficiency rules from the government. So supply is structurally shrinking.
And at the exact same time, demand is just going exponential. And the driver is artificial intelligence.
It's all about AI.
Exactly. Big tech is building these massive data centers. They need a colossal amount of power, which means just tons and tons of high-purity copper for all the wiring and infrastructure.
The investment takeaway here is pretty clear. Copper is truly the AI era's oil. You just can't build this digital future without it. So that 90,000 handle isn't a peak to be afraid of. It's a sign that the cost of building our future is structurally rising.
So for long-term exposure, things like copper ETFs like CPER or high-quality miners might make sense, but we shouldn't forget about silver in all this.
Oh, absolutely not. Silver is very attractive right now because it's kind of a two-for-one deal. It acts like a precious metal, a safety hedge, but it's also a critical industrial commodity.
For solar panels, electronics.
Exactly. So as the world ramps up manufacturing for this new era, silver offers a really high-return alternative to gold.
So while the structural inflation is, tightening the screws on consumers, we're also seeing these new capital blocks forming to bypass the West entirely. Let's shift gears from commodities to geopolitics and look at this Saudi-Japan corridor.
It's a fascinating shift. Historically, the relationship was pretty much a one-way street, right? Oil money from the Gulf flowing out to buy up Asian assets. But recent analysis confirms this has evolved into a genuine two-way superhighway.
And what's driving the traffic in the other direction?
It's low-interest Japanese capital, the yen aggressively flowing into high-yield Saudi projects, especially things like Neom City. This is signaling the formation of a capital ecosystem that is increasingly independent of the U.S. banking system.
And the Saudi market itself has become a huge magnet. Their stock exchange, the Tadawul, is getting close to being a top 10 global market. We're talking over $100 billion in foreign investment.
And their Vision 2030 plan is really transforming the country. Non-oil revenues are now over 50% of the total. But the real golden cross, the big symbolic moment, happened in late 2025.
What was that?
For the first time, the data shows their tourism and entertainment sectors actually grew faster than the oil sector. That's the moment you see the shift from a petrostate to a diversified consumer economy.
And if you're describing the capital flow as the superhighway, the data points to the actual, physical infrastructure of that highway being built, and the catalyst was ETF cross-listing.
This was a huge logistical deal. Explain why that's so important.
Well, on November 15th, the Tadawul and the Tokyo Stock Exchange did a world first. They simultaneously cross-listed ETFs tracking each other's markets.
Which means?
It means a Japanese investor can now easily buy a basket of top Saudi companies like Aramco using yen, and a Saudi investor can buy Toyota or Sony using rials. It completely bypasses the need to convert through US dollars. It's almost like a diplomatic treaty disguised as a financial product.
And the alliance goes deeper than just finance. It's become a strategic swap, technology for capital and content.
Absolutely. The data shows the Saudi Public Investment Fund, the PIF, has been buying up stakes in Japanese entertainment, Nintendo, Capcom, anime studios. They're buying soft power.
Well, on the other side, Japanese heavy industry Mitsubishi, JGC, they're winning these massive contracts to build green hydrogen plants and NEOM infrastructure. Japan gets energy security. Saudi Arabia gets critical decarbonization tech.
So what does this corridor mean for your portfolio?
Well, first, diversification. Putting a small slice, maybe 5 or 10%, into a Saudi ETF gives you exposure to a market that doesn't really move in lockstep with the US or China. It's a different set of risks and rewards.
And if you're a bit hesitant about direct emerging market investing, there's always the picks and shovel strategy.
Precisely. You can look for Japanese companies with high Saudi exposure. The engineering firms, the content creators, the construction companies that are directly profiting from all that Vision 2030 spending.
And there are currency implications here, too.
Yes. This steady flow of low-interest yen into high-yield Saudi assets, it structurally supports continued yen weakness. And on the flip side, all that Middle Eastern money acts as a kind of stabilizing floor, ready to buy Japanese tech stocks whenever there's a dip. It supports both economies.
That discussion of global capital flows is a perfect setup for our final section. A pretty urgent warning for retail investors trying to find yield right now. Let's talk about fixed maturity funds, or FMF.
These things have just exploded. The global market is now over $400 billion. And it was fueled by high interest rates, attracting investors who are just fed up with near zero rates in their bank accounts.
They're attracting those bond tourists you mentioned, people lured by this promise of, quote, principal plus alpha at maturity.
But they often miss the core distinction. The marketing is the problem. They're sold as if they're a high-yield guaranteed bank CD.
But they're not.
They are fundamentally different.
Yeah.
Bank CD is covered by deposit insurance, and FMF is not. You are taking on risk for that higher return.
So if they're being sold as this safe alternative, why are the fund managers dipping into such risky assets?
It's competition. As good quality corporate and government bonds became popular again, managers had to chase higher and higher yields to attract customers, so they were forced to go into the riskiest pools of credit.
And those risky pools are what the data shows are private credit and leveraged loans. Let's define why those are so dangerous.
Okay, let's break that down. Private credit is basically lending money to companies that are not publicly traded. They're often smaller, riskier, and you just don't have the public financial reporting you get from a company like Amazon.
So less transparency.
Way less.
Yeah.
And leveraged loans are loans to companies that are already drowning in debt. They're leveraged up, which means they have a much higher chance of defaulting if the economy turns down.
And we saw a real warning sign recently, didn't we?
We did. It was confirmed that bad debt from the bankrupt company First Brands was found inside some high-yield FMFs. It really spooked investors because it proved these funds are holding some seriously distressed debt to juice their returns.
Which brings us to the big technical danger that regulators like the SEC are looking at: liquidity mismatch.
This is the critical problem. The fund promises you, the customer, liquidity. You can get your money out on a timeline. But the assets inside those private loans are highly illiquid. They're really hard to sell quickly.
So it's like a crowded movie theater with only one tiny exit.
That's a great analogy. If there's a crisis and everyone runs for that exit a fund run, the manager can't sell those illiquid loans fast enough to pay everyone back at full value,
They're forced to sell at fire sale prices.
guaranteeing losses for the investors who are left.
So the most important thing for investors is this: you have to look past the attractive name, the 2027 maturity fund, and check the credit rating of what's actually inside.
Absolutely. Is it holding investment-grade bonds, or is it stuffed with junk? If the advertised yield is way higher than a normal government bond, that extra return is the risk premium you're being paid to potentially lose your money.
And for money you absolutely cannot afford to lose, that risk premium just isn't worth it.
Exactly. For things like retirement savings, stick to FMFs that only hold ultra-high-quality corporate or government debt. A smart investor knows that a market shock that blows up these risky FMFs is actually an opportunity for those holding cash to then swoop in and buy healthy assets on the cheap.
And that brings us to the end of this deep dive. When you put these three things together, you see a clear picture of shifting power and rising risk.
We started with copper's siren, called structural inflation is here, making everything more expensive. Then we saw how global capital is creating new highways, like the Saudi-Japan corridor, to work around the traditional dollar-centric system.
And that uncertainty is pushing everyday investors, the bond tourists, into these high-risk FMFs where the real danger is hidden in the fine print. The rules of the game are changing.
So to build on that idea of these new capital highways, the key question for you to think about is this. If this kind of sophisticated financial infrastructure keeps growing, and major blocks of global capital can manage their own risk without involving the US or Europe, what are the long-term implications for the perceived stability and the dominance of the Western financial system? That's something to keep an eye on.
Don't forget to subscribe and hit that like button.